Investing can feel like a maze, especially when you're just starting. The good news is, most new investors make the exact same mistakes. The bad news, those mistakes can cost you hundreds of thousands, if not millions, over your lifetime. Today, I'm breaking down the 5 biggest mistakes new investors make, and more importantly, how you can avoid them. We're talking real numbers, real examples, and actionable steps to set you up for success. Don't invest another dollar until you watch this. This is the classic blunder. You hear a financial guru predict a crash, so you sell everything, or you wait for the perfect dip to buy. The reality, even seasoned professionals cannot consistently time the market. A study showed that missing just the 10 best days in the market, from 1980 to 2018, would cut your returns by more than half. The solution: time in the market beats timing the market. Consistent investing, dollar cost averaging, is your best friend. Just keep buying, regardless of what the market is doing. Another huge trap is chasing trendy stocks or hot tips from your friends. Dogecoin, GameStop, we all saw the FOMO. The rule: if you can't explain what a company does or why it's a good investment, don't buy it. You're gambling, not investing. The solution: stick to broad market index funds like VOO or SPY. These give you a piece of hundreds of top companies, diversifying your risk. Or if you buy individual stocks, research them thoroughly, understand their business model, their financials, and their competitive advantage. Putting all your eggs in one basket is a recipe for disaster. I've seen people pour all their savings into one stock, only to see it tank. The lesson from Enron: people lost their entire retirement savings because they had 90% of their money in Enron stock. When it crashed, they lost everything. The solution: diversify. Invest across different companies, industries, and even asset classes: stocks, bonds, real estate. Index funds are great for this because they automatically diversify you across the entire market. The market is designed to mess with your emotions. When it dips, fear makes you want to sell. When it soars, greed makes you want to buy into risky assets. The pain of loss: studies show the pain of losing $100 is twice as strong as the joy of gaining $100. This is why people panic sell. The solution: set it and forget it. Automate your investments and avoid checking your portfolio daily. Focus on your long-term goals and stay disciplined, especially during downturns. Downturns are when you buy at a discount. This is perhaps the most fundamental mistake: investing without a clear goal or strategy. Are you saving for a house, retirement, a boat? Your why dictates your how, the impact. Without a plan, you'll be swayed by every market movement, every headline, and every hot tip. The solution: define your goals. What are you saving for? When do you need the money? Determine your risk tolerance. Are you comfortable with aggressive growth, or do you prefer stability? Create an asset allocation. How much goes into stocks, bonds, etc. Automate. Set up recurring investments. Review annually. Adjust your plan as life changes. This plan will be your shield against all the other mistakes we discussed. Avoiding these 5 mistakes will put you light years ahead of most new investors. Remember, consistency, diversification, understanding what you own, and a clear plan are your keys to building serious wealth. Which of these mistakes have you made, or are you actively trying to avoid? Let me know in the comments below. If you want to dive deeper into building your investment portfolio, watch this video next. See you there.